Good afternoon, everyone. Thanks for staying back and staying for our session. So this evening or this afternoon, we can kind of take this in any direction that you guys want. So we want you guys to get the most value out of it. We've got a heap of slides around kind of fundamentals to your finances. So how to kind of set yourself up for no matter what kind of stage of life you're at the moment. So we'll cover topics such as house purchase or refinancing, superannuation, personal insurances, and investing in the share market and or property as well. So we'll cover a lot of topics, but we can kind of skip over some if they're not of interest to the majority, or we can delve into more in further detail as well if you guys have particular questions. So my name's Scott and this is Alex. I guess just starting the boring slide first, if I work out how to... It's just a general disclaimer warning. So this is just general advice only, so it doesn't take into account your personal situation. So whatever we do say is general in nature.
Cool. All right. Thanks, Scott. So yeah, some of the things that we'll sort of cover today, firstly around property and purchasing a house and all things to do with property effectively. Your superannuation, so we'll talk a fair bit about that as well in terms of things to look out for there, things to consider when you are looking at your own superannuation and thinking about your own retirement. Personal insurance or protecting your wealth. So we'll talk a bit about income protection as an example, or life insurance and how that potentially sort of can fit into the mix. And finally, talking about investing predominantly towards sort of the share market, but mainly I guess what we're talking about here is investing outside super and some things to consider there when you're looking at that.
Cool. Can I just get a show of hands who owns a property in the room? Does everyone own a property? Majority of people. The people that didn't put their hand up, have you owned property before? No? Yeah. Okay. So there's probably half a dozen or so ones that don't. So I guess what we're going to touch on is kind of building your property portfolio. But if you haven't bought one before, there's a few tips that we'll quickly run through as well. So when buying your first home, your second home, your dream home, your investment property, there's a few considerations that we like to take into account. Firstly, where is it located? Now, in terms of a principal place of residence, this doesn't matter as much because you're not buying it for an investment unless potentially it is your first home and you're trying to jump on the ladder to climb to your dream home, which may be out of reach now, but it's kind of a future kind of pipe dream. So it's kind of considering at all times where we're actually purchasing. So ideally it's not on kind of a main road, it's near schooling, it's near train or public transport. So there's some of the things that we want to, I guess, consider. You can speak to the local councils, town planners and that as well to see kind of what's coming up in the area, if there's any new developments and things like that. And typically a mortgage broker will have access to information that the general public don't have access to around, is it in a flood zone or not, and kind of things that people don't generally think about when purchasing property. The second consideration is around how much deposit do I need? Now, it's becoming harder and harder to get into the property market if you don't have a property at the moment, given that prices are rising quickly and you need a substantial deposit. So you need at least a 5% deposit to get in. But ideally, when you are purchasing a property, you do have a 20% deposit because then you avoid extra costs like lender's mortgage insurance. So in terms of that, as an example, on $1 million home, that's 200 grand plus stamp duty, which is probably going to be close to 300 grand as an example. Now, there's some occupations that you can avoid lender's mortgage insurance with, such as doctors, accountants, lawyers, and so forth, and then you only need a 10% deposit. So if you're a doctor or if you've got a partner or spouse that's one of those occupations, that's important to note as well. Lender's mortgage insurance, though, at the end of the day, is not the worst thing. We would suggest if it is kind of going to take you a lot longer to save for the next house or your first home, potentially to pay the lender's mortgage insurance and capitalise that onto your loan. So i.e. that goes onto the loan, you pay a higher repayment, but at least you get into the property market. The risk that you have is if you continue to try and aspire to the 20% deposit, that 20% deposit keeps getting higher and higher as the property prices rise. So that's obviously the risk with that. Other costs with property is stamp duty. So everyone probably knows about stamp duty. So whether you've purchased a car or property before, there is stamp duty. The higher the value of the property, the higher the stamp duty charge. It differs as well state to state. First home buyers in the room, there are stamp duty concessions, so be aware of that depending on what state you're in. As an example, New South Wales, if it's under 800 grand, there's stamp duty concessions versus WA, it needs to be under 530, so it's very different kind of state to state. What will cash flow look like post-purchase, which I think is really important given the higher interest rate environment we're in at the moment. If we kind of reflect back on the last few years where it's been 2 or 3%, it's been kind of abnormal, I guess. The long-term average in Australia the last 25 years has been 5.64%. So we're kind of a little bit above the longer-term average. So in terms of where we're at the moment, it's probably going to remain around this, maybe 1 or 2 more rate rises, and then we should see some drops as kind of inflation comes down. But what you want to map out is if you're looking to purchase a property, what impact's that going to have on your lifestyle and your cash flow, or if you're upgrading. So quite often we're starting to see people now that put themselves in a position where they can't move on to their next stage of life, which may be having kids, winding work down, or whatever it may be, depending on what end of the scale you are, because they've got themselves into a situation where the repayments are quite high, and it kind of forces them into that income for the foreseeable future. And then lastly, just setting yourself up for future purchases. So what we're talking about here is just being aware of an offset account versus redraw and the functionality around that. So what we would suggest is if you've got a house, or if you're looking to purchase a house, potentially utilising the offset account in more often than not cases. Reason being is if you're using that to purchase another house in the future, and that might be 10 years, 15 years time, it's better to build up the offset account to use that money for the next house deposit if you're likely to keep the current house. Okay, so what I mean by that is when you're, if you're retaining your current property that you're living in and trying to kind of grow into your next property, you ideally want the mortgage on your current property to be as high as possible, therefore using the offset account to put down as a deposit on the next property, which then means your current property that you're in that's going to become an investment is more tax effective in the future. Whereas if you pay it off quicker and build up your redraw and then pull out that equity in the future, that equity you pull out is not tax deductible in the future. So it doesn't matter if you're only planning on holding one property at all times. If you're always going to sell, buy, then just pay it down, because your next deposit's going to be the sale proceeds. But it's more so around if you're planning to build a portfolio, to just understand the differences there and the tax outcomes in the future, not just now. Any questions so far? Yep. Yep. Yep.
Yeah, cool. So the question was the difference between redraw on a mortgage versus an offset. So the easiest way to think about it is let's just say you've got a $500,000 loan, okay, that you've gone to the bank, asked for the money, they've lent you $500,000. Usual loan term would say be 30 years, 25 years or something like that. So that's basically how long you have to pay back this $500,000 is 30 years plus interest, okay? Now, that will basically give you a minimum repayment at the current interest rate. Now, if you pay above that, okay, so more than the minimum amount, okay, that will often then build up what's called a redraw, okay, because effectively what the bank says is you've got 30 years to pay that back, okay, and you can pay more back at a period of time and then take it back. As long as you're always giving us this minimum, then that's fine. Okay, that's effectively what redraw does. So if you pay extra, okay, it will lower the interest part on the total loan, okay. Offset works exactly the same way. However, it's just money in a different bank account. So if the loan's $500,000 and you've got $25,000 sitting in a separate offset account, the total interest being charged on the loan will only be on $475,000 as opposed to $500,000. The advantage of this, potentially of what Scott was referring to before, in terms of from an investment property perspective, is potentially you're living in, maybe it's your first house or your second house and you don't intend on being there forever, and you want to turn that into an investment property in the future, it may make sense, therefore, to build up more money in offset. Okay, so you build up that 25 grand in offset, and then when you go and buy your next house, you pull that cash out and use that towards your deposit of your next house, which then makes the interest on that full $500,000 loan deductible. Whereas if you had the 25,000 sitting in redraw, okay, which you could still pull back, okay, technically the interest you could claim on that loan would still only be the 475,000 part, not the full 500. Yeah, so that's taking your redraw out. So you could take it back out. Okay, so you can take it back. It's exactly the same. It's just the difference is often from an investment property perspective, because you've technically then paid that part of the loan off, okay, before it was an investment property, that part of the loan won't actually be, the interest on that won't actually be claimable, as an example. But they do work largely the same. And they work exactly the same in terms of how much interest they're offsetting on that loan. An offset account will often cost a little bit extra money as well, depending on the lender as well, something to consider. But it just effectively means it's maybe a little bit more flexible if you are thinking of maybe turning that property into an investment property in the future.
Yeah, redraw then is fine. Yeah.
Correct, yeah. The other hypothetical risk with redraw is the bank can technically take that at any point in time. Now, that's very rare. That doesn't happen very often. But technically, they could take that money because you have technically paid it back. Okay, and then they could clear it, as an example.
Yeah, so you don't lose the money, it comes off your loan, but then you need to then go through an application process to get that money back. Then that's based on your income, your situation and stuff, so it may be hard to pull that equity back out in that case.
And where offset potentially is more flexible, even if it is your final home, is potentially you are thinking about retirement. So as soon as you retire, they're probably not going to lend you any more money because you no longer have an income from a wage, as an example. So potentially parking that more in offset as opposed to redraw still then gives you access to a large lump sum of cash if you suddenly need it for some sort of reason as well. You are, because remember, you've got to have that payback within say whatever the loan term is, 30 years or anything like that. So you'll still do your minimum, okay? However, you just won't be paying any interest, okay? So if it's it's a brand new 30-year loan, $500,000 borrowed, you immediately offset that with $500,000. Over 30 years, that the money and the loan would just slowly drip down to zero. Does that answer that a bit? Does that make sense?
A bit more. Thanks for the question. So what we just wanted to quickly just run through for those that haven't bought a property before, or those with younger kids who may be looking to purchase soon, is utilising the First Home Super Saver Scheme.
Cool. All right. So, as Scott mentioned, if you haven't purchased a house before, this is a government incentive which was brought in about 5 years ago now. Effectively, what it is in a nutshell is a way that you can save tax, okay, which effectively then gives you more money, which you can put towards your first deposit. So what you're allowed to do is put extra money into your super fund. So it needs to be above the super guarantee rate that your employer has to put in. So it has to be an extra amount, either through salary sacrifice, which you guys may have heard of before, or you make what's called a personal contribution, okay, which is an after-tax contribution, which you then put on your in your tax return. The net effect is identical. So some sort of method through that. What that means is that money is then taxed at the super fund rate, which is 15%, as opposed to your own personal rate. So in this example, we've used 34.5%, which would mean you'd be earning between $45,000 and $120,000 in this example. The more you earn, by the way, the bigger tax saving you'll have. In terms of how much you can put in under this scheme, it's $50,000. However, you can only put in $15,000 per financial year. What we've given here is just a bit of an example of, say, one financial year, so the full $15,000 during that year. The money goes in, okay, into super. It's taxed at 15%, so that 15 grand gets turned into 12,750, okay, in this example. You are then allowed to withdraw that back out the other side if it's to be used towards the deposit of your first home. There is often a tiny little bit extra tax to pay, and there's some earnings that are deemed on that as well. We haven't really run through that on this slide because it becomes a little bit complicated, but effectively the numbers stay sort of as they are here. And the difference we've got here, as opposed to you receiving that 15 grand in your own name and putting it in just in a savings account. Okay, so the difference is about, I think it was about three grand, okay, for this person in that financial year. And remember, they could do this another 2 more times as well. So for the average person, earning anywhere between 45 to 120, it's worth around 10 grand in tax savings, which is then just simply extra money they can put towards their house deposit. In terms of the rules around this as well, there's no income level restriction or anything like that. You just simply can't have bought a house before, and you need to live in it for the first 6 months of the first 12 months upon sort of purchasing it. And it's available as well potentially where you've got a situation where a partner's already bought a house, and then you're going to go and buy a house with that person. You can still use it in that example as well, which often sometimes knocks out other first home buyer concessions that states offer.
And it also helps people that are poor at saving money because it's out of sight, out of mind. It's in their super. They can't touch it or get it back until they purchase their first property. So not only those tax benefits there as well. I guess we just want to finish off on renting versus owning. We often hear the statement of I'm paying someone else's mortgage if I'm renting. It's not actually the case anymore with where interest rates are. So just a quick example here of kind of a median kind of mortgage these days, which has slightly gone up the last few months. It's around 700 now, but use 650 here as a mortgage. That's kind of on an 800 grand property. Rent for that would be roughly 550 a week. So you're paying kind of 30 grand a year in rent versus mortgage repayments at 6% of $900 a week. And of that $900 in the early years, $750 of that is interest. So I guess that I'm paying someone's mortgage, it's a lot cheaper to rent if you can find a rental at the moment. So from a cash flow point of view, it makes sense. But the benefits of owning a property, particularly the last 3 years, the property market has gone bonkers all across Australia, and therefore you would have been way better off. But yeah, it's just down to kind of what you need, but or what you're looking for at the moment. But it's just kind of showing here that renting is cheaper, generally speaking, than having a mortgage from a cash flow point of view.
Yeah, so that's why it's particularly important if you don't intend to own a property in the future that you are doing something else with your money to effectively compensate that, because often having your own principal place of residence, it's often a forced way of saving as well for people too, because they just get used to paying that mortgage over time, and the asset appreciates, as Scott sort of went through before. Of course.
Yeah, and I do agree with you. And sorry if I glossed over that point from a cash flow point of view. So your money in versus money out, you're in a better position renting. But from a wealth creation point of view, you're worse off. Yeah, so sorry I glossed over that, but I do agree with you there, yeah.
Does that make more sense now, what I point was?
So yeah, to Alex's point, if you are renting, you should potentially be looking at investing, say, in the share market and building your wealth through other means outside of property, if that's not a goal of yours.
Okay, superannuation. Okay, so not always the most exciting topic, but is quite important. So super for most people in this room will typically become your largest asset, if not sort of your second biggest asset behind potentially the family home, if you've decided to sort of go down that route. So it's very important, therefore, that we basically pay attention to it. So yeah, that's that point. Thank you. As I mentioned before, and as I'm sure you're all largely aware of, when you are working and earning a wage, your employer has to contribute some of your wage towards super every pay cycle. And then currently that's sitting at sort of 11% and is earmarked to go up again to 11.5% next financial year. A super fund is the best tax structure that you have available to yourself currently. So it only pays tax at 15%. So it pays 15% on the way in of any contributions, and then any money that money makes, it also pays 15%. So in most people's cases, similar to the slide I was sort of showing before, if you're earning between 45,000 to 120,000, you would pay 35.5%. So the super fund is paying less than half that, as an example, to sort of put that in perspective. And then similar to what we touched on before with the first home super saver scheme, if you're not doing that, you can still do this as well around salary sacrificing extra money in. And that's one of the key reasons why people often salary sacrifice money into their super or extra money, because then they're only paying tax at 15% as opposed to 34.5 or 39 or 47.5, depending on where you sort of sit within those tax brackets.
Yeah, and a good strategy with that, if you're heading towards retirement and you're nearly at the age of accessing your super, which for most people in the room will be the age of 60, is salary sacrifice. Even if you have debt, salary sacrificing money into super so you pay less tax, and then you can access your super to clear your debt at a later point in time as a lump sum. So that just means a better way of making your money work harder for you and paying less tax to the ATO, but still getting to the point of a comfortable retirement and being debt free, just in a different kind of way of doing it as well. In terms of reviewing your super, so a lot of the time people will stay with the super fund that they started with or joined, depending on their workforce, and we'll just assume that is the best one for them. And I guess the earlier you can do this, the better, and the longer you have for this to compound and take bigger effects with the changes you make. So some of our tips, I guess, for reviewing a super fund is firstly making sure it's consolidated. So you're not paying extra fees, and the fees are super fund fees, but also insurance costs. So if you have multiple super funds, potentially you'll have multiple insurances in there, and that you may be overinsured or paying for stuff you can't actually claim on. Easiest way to check this is on MyGov. You might also have lost super. So if you have super accounts from back when you were a teenager or whatnot, and they were less than $6,000, they would have been sent to the ATO by now and be sitting as lost super. So it's best to go and claim that, because that money's not doing anything for you. It's not going backwards, but it's not earning anything. So it's best to get that into your hands, into your super fund. Look for a low fee fund. Harder said than done, because you do need to go through the product disclosure statements, which will be very, very boring. But all super funds charge a percentage fee of your balance. So if you've got, say, 50 grand and the fee is 1%, which is the industry average, you're paying $500 a year. If the balance is 500 grand, then you're paying $5,000 a year. So you can kind of see the more you have, the more you pay, which is why it's important to review that percentage fee you're paying. And the earlier you can do that, the longer it has to compound and make a bigger saving or outcome to you. Review your investment options. So that, again, quite often most people will just stick to their default option that the super funds allocated them to. You do have the choice of where your money goes, okay? And when I say that, the difference between sitting in kind of defensive assets like a bank account or cash versus the share market. So you can kind of be on any end of that scale. You can be aggressive and be all in the share market, or you can be very defensive and sit your money in the super fund's bank account. So you're never going to see it go down, but it won't appreciate that much in value, maybe 3 or 4% on average a year. So depending on your stage of life, we would suggest kind of different profiles or a different kind of mix of that. So if you're 20, 25, you probably want to be quite aggressive, because we've got 40 years until we can touch this money. So if there's a few share market downturns, financial crisis, then we have time for that money to recover. And history tells us the share market will average 8 to 10% a year versus kind of long-term cash rates of 3 to 4%. If you're, say, 50 and above, potentially you want to be fully in the share market, because if there is a crash and our account drops 20, 30%, maybe we don't have enough time to let that recover. During the global financial crisis in 2007, it took about 5 or 6 years from the peak for it to get back to the kind of the previous high. So it does take time to recover. It always does recover. It just takes time. So if your time from accessing your super is getting shorter and shorter, then it's equally as important as when you're younger. And then reviewing your death benefit nomination. So there's only a couple funds in Australia that doesn't allow this. So those in the room that are with GESB, you can't nominate a beneficiary. But nominating a beneficiary is super important, and nominating a valid one. Okay, so what is a valid nomination? There's 4 types of people: your spouse or de facto, a minor child, so under 18, an adult child under 25 that's financially dependent on you, so they live at home, go to uni as an example, and someone you're in an interdependent relationship with. So what that is someone you physically and or financially care for. So again, quite often we will see people that have nominated their mum, their sister, a friend, someone like that. They're not actually a valid nomination under those 4 criteria. So what would happen if they were to pass away? The super fund would reject that nomination, and then it would go to the estate. So best practice there, if you're not nominating your spouse or de facto or children that are under 18, is to nominate your estate, which is your will, and then have a valid will up to date. That's the safest way to get around that if you want to nominate a sibling or your parents.
And just on that as well, quickly with the nomination, even if you do have a spouse as an example, but you don't intend to leave your super fund to them for some sort of reason, and it's effectively then done through your will, it is making sure that you have correctly nominated your estate, because if you haven't, the trustee will use their own discretion in terms of where they send the money, i.e. they could still send it to your spouse because they'll just decide that that's what they want to do. All right. Just tying what Scott was sort of saying then together with a bit of a graph. So in this example, it is looking at effectively making sure our fees are as low as they possibly can be, and then also the difference between 2 funds. It's not showing too well there on the projector. So we're looking at a balanced investment option, which is the blue one, and a high growth one, which is the green. In this example, this person is 27 years old. They've got a $40,000 balance in their super fund, and they earn $90,000 a year. The blue one, the balanced investment option, so that will have about a 50-50 split between defensive and growth assets, and we've assumed it earns 5% a year on average. The green one has got a 85% split towards growth and 15% towards defensive, and we've assumed it earns 7% on average, so only a 2% difference. The blue one is paying fees of about 1.2%, which is typically the industry average, whereas the green one is paying 0.55%. If we then extrapolate that out over this person's working career from 27 to 65, the end difference between the 2 balances is almost $800,000. So the key here looking at this is effectively to look at your super fund ultimately and make sure that you are paying as little fees as you possibly can, and it is invested correctly for your current life stage as well. And one thing as well, I guess I'll add to that, is towards the end, so when you can sort of start to see retirement and things like that too, it's making sure that you're not necessarily going too conservative as well. So not just moving everything to cash as an example, because that will potentially affect your long-term returns still going forward, because most people don't intend to, I imagine, turn 60, retire, and then die a year later. Okay, you could potentially still live for another 30 years. So it is making sure that you are leaving enough money there to still make you more money in the event that you do potentially live to 90 or 100 as an example.
Any questions on super, guys, or want us to take any different directions there, or all good with that? Yep. $1 million question, maybe $1 million. It really, so you'll hate me for saying this, but it depends. What we look at with retirement planning, which we'll delve in a bit more in our session tomorrow, but it's more about what your lifestyle is. Okay, so your lifestyle compared to mine may be, you like traveling and spending 30 grand a year on expensive overseas holidays, whereas I just like going out in the bush and camping as an example. So in terms of that, in terms of retirement, you'll need more money than I do. So firstly, we work that backwards, but the comfortable kind of lifestyle that the government is saying for a single at the moment is 52 grand a year tax-free. And
for a homeowner.
For a homeowner, and 70 grand for a couple. So in terms of how much you need for that to sustain is a tad over $1 million. And
again, you're pulling a bit of a face there, Sheree. So again, and that's why it is kind of how long was a piece of rope kind of question, because 70 grand to some people or to a couple may be plenty of money. To other people, it may be nothing, as an example. So that's just a guideline that they try to put out sort of every year. And in that example, yeah, it assumes that you own your own home, means that you can pay all your bills, you can have medical insurance, you can go to the movies, have a gym membership. It includes one overseas trip every 7 years, which for most people in this room is probably not going to be acceptable. Or yeah, so again, it really does come down to your own personal circumstances, and yeah, you do need to sort of think about that as soon as you can.
Yeah, and I guess like with this graph, that blue line is just getting a tad over $1 million, and this person's earning 90 grand a year. So the benefit, I guess, that younger people in this room have is you're forced to save for your retirement from day one, and it's kind of 9.5% or above from day one, whereas it hasn't been around and mandated for that long in Australia. It's only kind of 30 years now. So as kind of the younger generation hit retirement, they're going to have a lot more money. So retirement, the government pension will kind of cease to exist in the future, we believe. But that's where it's still an important part of someone's retirement plan now, because people retiring now haven't had super their whole working lives, and if they had, it started off being kind of 4-5% of their wage, which was lower than it is today.
Yep. Question? So the question was, is there a difference between a self-managed super fund and just a normal super fund? Was that? Yeah. The answer is no. There is no difference. A self-managed super fund gives you more flexibility, possibly in terms of what you can invest in. So the classic example of that is you could buy a direct property in a self-managed super fund, whereas through a standard industry fund, you'll have property exposure, but you won't be able to buy a residential property. We are running through tomorrow in detail around self-managed super funds, when you potentially would have one, pros and cons, the costs, those sorts of things. But in terms of from a legislation point of view, there is absolutely no difference between the two.
Yeah, so same tax rate and stuff, but yeah, if you want property or buy artwork and stuff, then you need self-managed super fund. On the other side, there's a lot more, you're in charge of your own super, so a lot more compliance risk. So you need to make sure you understand the rules, otherwise the ATO will penalise you because now you're the trustee of your fund. So a classic example we see is people will move money out of their self-managed super fund bank account, put it onto their mortgage, say, I'll transfer that back in at a later point in time. That's a breach, because you're under the age of 60 and can't get access to your super, as an example. So there's a lot more kind of compliance risk with doing it as well. Alrighty, another interesting topic, personal insurance, when it pops up. So this kind of follows on from the super fund conversation and having a review of what's in your super, and a lot of people will have default levels of insurance. So it's important to look at that. And there's potentially 4 types you may have. So life insurance, probably the easiest one to understand or comprehend. If you pass away, a lump sum of money is paid to your family or your beneficiaries. Total and permanent disability. So this pays out if you're unlikely, keyword unlikely, to ever work again in an occupation you've got reasonable skills, knowledge and training in. So it's not you're a complete vegetable, you're never working in any industry ever again or any job. It's any kind of suitable job with reasonable skills and training. Trauma insurance, probably better termed here as critical illness. So this pays out upon 45 conditions, most notably cancer, heart attack, stroke, but 45 kind of included in that as MS, Parkinson's, motor neurons and so forth. This pays a one-off payment if you're diagnosed with one of those conditions, which then helps with medical bills. And then lastly, income protection. So this protects your income, which we believe is one of the most important assets you have, is your ability to earn money. This protects that. So if you can't work because you're sick or injured, mental health related as well, this will pay out 70% of your wage, up to 70% of your wage, until you're able to go back to work or until the benefit period ends.
Cool. All right. So then we'll just very quickly explain then potentially looking at these types of covers, when you may consider them or not. So when it comes to life insurance, you generally would have it if you potentially have a mortgage debt as an example. But mainly it's if you need to provide future living expenses for your family or you have dependents, i.e. if you're not around anymore, people are going to suffer financially as a result. That's generally when you would consider potentially having it. Total and permanent disability. So as Scott mentioned before, an injury or illness that you've suffered and now you're unlikely to ever be able to work again. So we would consider, again, potentially covering the mortgage in that example. But the biggest thing for most people is that future loss of income. So what we're referring to here is everyone in this room is obviously qualified and earns a decent wage and stuff like that. So you yourself are an asset, okay, or a money-making machine. If you suffer an injury, illness, and then you can't then realize your potential over that working career, you then have, as a result, have missed out on making a fair bit of money due to that. So it's potentially looking to insure some of that through TPD as an example. Trauma insurance or critical illness is a better way to explain that. Again, you look to potentially just have this in place that if you do suffer one of these illnesses, you have a small lump sum of money there to help with any sort of short-term income loss and potentially help with any out-of-pocket medical bills that you may have. And then finally, income protection is just simply replacing your wage. So instead of being paid by your employer, you now get paid by the insurer as a result.
Yeah, so I guess what we're getting at here, most people will have life insurance, permanent disability, income protection in their super as a default. It's normally not enough. Most super funds will only give you kind of $2 or $3 grand per month. And most people in this room probably could get $6-7 grand per month cover or more. It also normally has a limited benefit period of 2 to 5 years, whereas you can get one that pays you until you're 65. So it's just kind of looking at the insurance as part of the super fund review as well, and just making sure that you're not paying for stuff you don't need. Say you're single, you live in your own home, and you're paying for life insurance. Maybe you don't need that, because if you were to pass away, the house gets sold, clears the mortgage, and there's super and other assets left for your remaining family. So it's just kind of reviewing that you're not paying for stuff you don't need, but also you're not underinsured as well. Any questions on insurance? No. Yeah. Yeah. So you can these days you can have an independent organisation, but still have it paid from your super fund. So you can kind of have the best of both worlds. I have the best super fund for my position, the best insurance company for my position. They can talk. I can sign off that they talk. The other, I guess, part to that is it better that I pay for it out of my cash flow or my bank account versus my super? Income protection is probably the only one that makes sense for the bank account to pay for if we can afford it, because it's tax deductible. Whereas if it comes paid from my super fund, it's tax deductible, but at 15%. Versus my marginal tax rate of 34, 39, 47%. So income protection is probably the one out of the life insurance, permanent disability that you may already have that would make sense to pull out if you can afford it. Yeah. Thanks for that.
Yeah, it's just really considering the tax deduction and whether you've got the cash flow when it comes down to it. Life insurance, for example, you can get the best of both worlds in that you can get a tax deduction inside your super fund at 15%, so basically 15% cheaper. And then if it's paid to a spouse, there's actually no tax paid on the benefit. Okay, whereas generally if you're getting a tax deduction, if you then get paid the benefit, there'll be tax to pay on that.
Cool. We just want to just quickly close off just with investing. So whether that's property or investing in the share market. Has anyone here kind of started investing or done lots of investing in the share market before? One or two? ETFs? Yep, cool. Great. Yeah, not so serious shares. So why do we encourage people to do this? So it's to build their wealth quicker, and we encourage people to start earlier to building their wealth so that they've got options earlier in life. Most people will be able to access their super fund from 60. That's what it is at the moment. Potentially that age will go up as time goes on. So you may not want to work until that age. You may want to semi-retire, fully retire, or have options before you can access your super. So in order to do that, we need passive income, whether that's through investment properties or shares. Okay, I guess why we're talking about shares is because it's more flexible than property. If you need money, 10 or 20 grand, you can't just sell part of the property, whereas shares, you can sell portions of it and get that money, as an example. Okay.
Cool. And yeah, we are big advocates of property as well. I guess, yeah, what we're talking about here, though, is shares is basically a little bit less common, and you can start with significantly smaller amounts of money. Okay, so 4 things to think about when you are doing sort of any investing. Okay, and in this example, again, we're talking about investing outside super. So firstly, it's thinking about the time frame. So the time frame is basically how long until you want the money back is the easiest way to think about that. So for example, it could be a year, it could be 10 years, it could be 20 years. And depending what that time frame is, then should help us in terms of which pathway we pick, in terms of do we go for more growth assets like property or shares, which generally you need to hold for sort of 10 years plus to effectively guarantee that you'll make money. Or if it's only a year, as an example, is potentially a savings account a much better idea, because we're not going to get any volatility, but we're also not going to get the same return per se either. Number 2, diversification. So what we're talking about here as well is the old adage of not putting all your eggs in one basket, as an example. So to sort of relate it back to property, something that we see quite often is people will buy their first house, and normally that goes relatively well over time. But then they may look to buy an investment property, and often they'll buy, say, the street over or the same neighborhood or something like that. There's nothing necessarily wrong with that, but that does mean that then they have a lot of money correlated in one spot. So they will be then their return will be very beholden on what those properties do, which are only in one country, in one state, on one street, as an example. So it's making sure that we're considering all opportunities per se, because potentially there's other places that we can make more money, and it also reduces our risk. So in the share market, for example, if you're buying miners and you're buying financials, so banks and BHP per se, and the miners aren't doing very well, so we're losing a bit of money there. However, the banks are doing really well, so we're making money over here. And that's basically what diversification is. It's spreading that risk. Number 3, ethical preferences. So within the share markets, or ETFs per se as well, there are now a lot of options that if you do want to invest ethically in a certain direction, so for example, if you don't want any exposure to fossil fuels or mining or something like that, there are a lot of products that you can now utilize that will enable you to do that. We just do encourage, though, don't just buy it if it says ethical. Make sure that you actually read the charter, i.e. what they stand for, what their ethics are, and they align with your own. And you can, with all ETFs as an example, you can check the top 10 holdings. So we just bring that up because often when clients come to see us, they may have bought an ethical ETF or they're in an ethical super fund, but they don't actually know what it's investing in. And to be honest, more often than not, when they do know, it doesn't align with their ethics. So just bear that in mind. And then finally, number 4, the instrument to purchase. So once you sort of had a bit of a think about these things, it's, do I buy direct shares? So buy BHP as an example. Do I buy something called an ETF, which stands for an exchange traded fund? Do people know what ETFs are when I say that? Okay, so some people are nodding, some people are shaking their heads. So an ETF, which stands for exchange traded fund, okay, so effectively just means that something that you can buy on a stock exchange. So you may have heard of the ASX before, which is the Australian Stock Exchange. ETFs have become very popular over the last 15 years because they allow retail investors, which would be pretty much everyone in this room, okay, the opportunity to potentially buy or get diversification very easily for a small amount of money, i.e. you could buy an ETF for $500 and the underlying holdings within that ETF may be the ASX 200, okay, which is the top 200 companies listed on the Australian Stock Exchange, okay, for one transaction fee. Whereas prior to that, if you wanted to get all 200 companies, you would have 200 transactions, which again, for most people in the room would just wipe them out with cost. Does that make a bit more sense now? Yeah, so that's what an ETF is. It's effectively a basket of shares, and there's tons of them these days in terms of what you can do. And then, obviously property, which we've talked about a fair bit as well. All right, I know it's very late in the day. It's only got 1 or 2 more slides left, so quick pop question, which potentially will go off script as well, and we'll give our door prize to whoever, if anyone can answer this within $20,000, we'll say. Okay, if you invested $10,000 30 years ago into the Aussie share market, how much do you think it will be worth today?
How much? 3 million.
3 million, 1.5. All right, you're all going to be sorely disappointed, but the answer is, well, as of the end of last year, this is slightly out of date, but as of the end of 2022, it would have been worth 131,000, or it would have returned 9.2%. I know it's a bit blurry in terms of the Aussie share market.
Yeah, but you compare that to cash, and I know it's hard to see, but it's the kind of the one above the red line. Doesn't ever go back, but it's very, very straight, right? And that gets to 35 grand. So 10 grand in 30 years sitting in a bank account, just getting interest over that time turns into 35 grand versus 131 grand if it's in the Australian share market, or if it was in the US share market, $182,000. That's not contributing extra, which is why people may have said 1.5 or 2.5, but your door prize is safe, Quint, for tomorrow. Just to, I guess, finish off, just showing, again, kind of some projections. These are pretty basic projections, but just if we are to, say, contribute a little bit of money every month to an investment portfolio of ETFs or shares, whatever it may be, and if we kind of average close to 7% a year, if we're doing $700 a month, that can grow to kind of a value of a property, albeit in a long time, kind of 20, 23 years, but you've then got more diversification. And to my point earlier, if we need 100 grand, we can sell 100 grand of this. If we've got only properties and we need 100 grand, we need to sell a whole property. So it just gives you more flexibility. So we're very much advocates of having both if we can. So property that you live in, ideally then an investment property or two, but then also not neglecting kind of the share market as well, because it does provide diversification in the main.
Yeah, and that just goes to show that, yeah, putting in $700 a month for 23 years turns into $500,000 as well. Okay, final slide. Okay, so things to sort of take home from today, which we've largely sort of talked about. So making sure, which most of you are property owners by the sounds of it, that you've got a competitive interest rate. So potentially they're going up next week, by the way, in which case this slide will be irrelevant. However, sort of high fives to low sixes is what you should roughly be paying, depending on your situation and loan to value ratio and stuff like that. But that's sort of the ballpark. So if you're not paying that, or you're paying well above that, potentially have a chat to your mortgage broker or have a chat to your bank. Do you have a plan in place for your next property? So again, if property is something that interests you and you want to build out your portfolio and stuff like that, it's making sure you are always thinking about that next move, because property is large amounts of money each time. So that needs to be executed as perfectly as possible. Review the super. So as we said, check the fees, make sure you've got a beneficiary nominated that is valid, and make sure your investment option is appropriate for your current stage of life or your current level of risk that you want to have. Insurance, so make sure that if you do need personal insurance, you have the correct amount in place. And as Scott was saying as well, make sure that if you don't need it, you're not paying for it as well, because that's just a waste of money. Do you have a plan in place to build passive income outside of super and outside of your home? So as we sort of just showed you there, from a small amount of money, you can create a passive income which will allow semi-retirement or early retirement. And we haven't talked about this too much, but we did kind of touch on it throughout the presentation, is do you make sure you have a will in place and it's up to date as well, because that's something that most people haven't done, or it's very, very old if they have.
And just with the mortgage conversation, just to close off on this, there's no harm in just giving your bank a call and asking for a discount, because 9 times out of the 10 they will give you one if they haven't already. So just making a call, and they should be able to shave kind of 0.1, 0.2% off, which again, every little bit helps in this environment.
Cool. All right. So we will throw it out to questions if you do have any. We know we're standing between you guys and a few bin tanks, so I'll finish this up very quickly. So yeah, my name was Alex. This is Scott. We're from Everest Wealth. We are financial advisors. We do help people Australia-wide as well. We did hand out a feedback form there as well, so we'd really appreciate your feedback. If there's a way that we can improve the presentation, that would be awesome. Likewise, within our company, we do offer a free 15-minute call as well. So if you want to do that, we can have a bit more of a chat about your own personal situation and whether we could potentially help and add some value to it. And finally, we will be on tomorrow morning as well. I know some of you guys are going on tours and stuff like that, but for those of you that aren't and you want to hang around for a more intermediate session, in which we'll look at self-managed super funds, debt recycling, retirement, thank you, and more in-depth stuff around using equity to purchase future properties and stuff like that. We'll be discussing that tomorrow morning too.
Is there any last questions that anyone has before we close off? Oh, good. Well, thanks for staying back, guys. We really appreciate it, and hope you enjoy the rest of the conference.